Yo, what's up, my friends? So, on today's episode, we'll be looking at the different types of financial market orders. Whether you're trading forex, you're trading crypto, you're trading stocks, you're trading indices, every type of financial market, every type of market that you're trading, you're definitely going to experience these different types of orders. You're going to see these different types of orders. So the essence of today's video is for us to look at, have a deep study of these different types of orders, what they mean, and when you can conveniently use them in order to maximize every trading opportunity that the market presents. All right, before we go right ahead, if today is your first time of visiting this channel, I encourage you to kindly hit the subscribe button. And if you are just watching it and you're liking what we are doing, kindly hit the like button. You could as well share it to your friends. And there's any question you want us to talk about, there's anything concerning trading you want us to clear you on, kindly leave the question at the question section or at the comment section of this video. Subsequently, we're going to do video to adequately take care of it. So if you've done all that, let's go ahead. Different types of financial market orders. There are basically four types. Of course, there are other subtypes of them, but these four are the major types of orders you'll be seeing in the market, in the financial market, either for a crypto stocks or whatever it is you're trading. So the first one is the market order. We have the limit order, stop loss, stop order, and finally we have the stop order. So we're going to take a deep look into each of these types of orders in the financial market. Okay, so the first order type we have is the market order, and I define market order as the order to buy at the current market price, no matter what. Let's say the price of gold is 2030. So whenever you use market order, what you're doing is that you're buying at the current market order, at the current market price. You're buying at that 2030. You're not buying it lower, neither are you buying it higher. So market order, what it does is that it makes you to enter the market. So the advantage of this type of order is that it guarantees you enter a trade. Most times people do this when they do not want to miss an opportunity or when they are very sure of the trade. So they just use market order to get in immediately so that they don't miss that opportunity. And then the disadvantage here is that you might get slippage during volatility. Yeah, you might get slippage. So in other words, you might be charged higher. You might pay higher fee than you ordinarily would if you were using the other types of market order. So that's the advantage. It ensures you enter the trade. And the disadvantage is that you get slippage, especially during volatility. So the second type of order we have is the limit order. But in this limit order, we'll be considering the buy limit order because the limit order has two types. We have the buy limit order and we have the sell limit order. So what limit order does is that it helps you to buy below the current market price. It gives you the opportunity to buy at a price, at your desired price. Let's still use the gold again. The current price of gold is 2030, but you're believing that gold will drop to 2025. So by putting your buy order at 2025, what you are doing is a limit order. You're buying it at a price lower than the current price. So the advantage of this is that it makes you to buy at your desired price, or it makes you to buy at a lower price. Let me put it that way. And then the disadvantage is that you may miss the chance to buy. If you put limit order, let's say the price of gold is 2030 and you're putting it at 2025, it's possible that gold price may not drop back to 2025. Instead, it will continue from that 2030 up to 2050. So this is the disadvantage of using the buy limits order. The same thing also applies to the sell limit. So the major thing is to understand the parent order, which is the limit order. If you understand the limit order, you will now know how to use the buy limit order and the sell limit order because they all do the same thing, just in different directions. Okay. So the next type of order we'll be looking at is the stop order. The stop order. When it comes to the stop order, there are two types of it. We have the buy stop order and we have the sell stop order. So what a buy stop order does is that helps to buy if the price moves above a specific level. Let me give you an instance. Let's say the price of that same gold is 2030. And then you believe that if gold gets to 2035, nothing would stop it from getting to 2050. But then if it doesn't get to that 2035, you don't want to enter the market. If it doesn't get to 2035, nothing will stop it. Nothing will make it to get to 2050. So you put your price, you put your buy at a price higher than the current market price, so that if the price comes there, it will definitely execute for you. Okay, so um the advantage of this is that it is useful for breakout trading. And then disadvantage here is that there might be a false breakout. Let's say the same gold we are talking about, you are assuming that it will get to 2050, but before it gets to 2050, you want it to get to 20, you are thinking it must get to 2025. So it's possible that it will get to that 2025. Instead of going up, it will start coming down. So majorly, we use this other type, this buy stop order, you use it especially for breakout trading. So when you're anticipating a breakout, so you put it at the breakout points, at the points where you know that if it eventually breaks out, it will continue to go. So most at times, the breakouts doesn't continue. Most at times, it reverses and becomes a fake out. In other words, it becomes a false breakout. So this is what the buy stop order does. It helps you to buy at a price lower, higher than the current price, because you're anticipating a breakout. So it's useful for breakout trading. And then the next type of order we'll be looking at the stop loss order. Stop loss order is used to limit your losses and reduce risk exposure. Of course, we should know this. I'm sure we all know what a stop loss order does. It helps you to curtail your losses. It helps you to, cap your losses. Fix a limit on the amount of money you're willing to lose in the market. The advantage here is that it protects your downside, and then this disadvantage is that you might get stopped out prematurely, especially when you have not understood how to put stop loss. So if you don't know how to do this, if you are still confused on how to put your stop loss and how to properly place your stop loss, search this video. Look at the other videos I've done. I did a comprehensive course on how to adequately place your stop loss by using a particular indicator called ATR, average true range. So just search the videos. Search the different videos I have. You see a video I did concerning this, how you can adequately place your stop loss during trading. Okay, so to wrap it up, market order gets you into a trade immediately. Limit order gets you into a trade if the market comes to a specific price level. And the stop order gets you into a trade if the market exceeds a specific price level. Whereas stop loss order gets you out of the trade to protect your downside. All right, guys. So this is just the thing I wanted to share with us today. If you find it educating, if you find it interesting, kindly hit the like button, share it, subscribe, and I will talk to you guys soon. Hands ahead. Salute.